All right, so I'm going to start here. You should see on your screen there, it says LPL Research presents Outlook 2022 Passing the Baton. And I enjoy sometimes, most times, LPL does come up with kind of unique approaches here to show this concept of passing the baton. And what they're trying to convey here is that if you think about it, our economy really grew very strongly at about a 6% rate in the first half of 2021, and probably overall about 5%. And what they're trying to convey with this image here is that we had this 2-month recession back in March and April of 2020, primarily caused by COVID. And yet over the last couple of years, we really had a hand up in helping us through this very difficult period. And this includes things like vaccine availability, fiscal stimulus. So I guess the point they're trying to make here is that they're trying to look for a smooth handoff from a lot of these stimulus programs, hand-holding programs, to get back to a more normative situation where the economy is kind of chugging away on its own, rather than because of all these stimulus programs. And one thing that I thought was kind of interesting is, it says that the economy grew at over 6%. Well, I think the people that write these things don't think about, someone reading them, because not everybody knows what a 6% resurgent growth means. And what they're really meaning here is the gross domestic product. And that's a calculation or an estimate of the value of all of the goods and services that were provided within the United States last year. So if you hear somebody talk about GDP, that's what they're talking about, is how much did the country produce over the past 1 year. The other thing that you'll hear is the phrase fiscal policy and monetary policy. And monetary policy is predominantly managed by the Federal Reserve, whose objective is to balance that fine line between the optimal amount of employment or unemployment, along with interest rates or inflation. So you may hear that phrase. And we've been operating under a monetary policy to a certain extent over the last couple of years. You hear fiscal policy, and fiscal policy is typically much more aligned with the administration, the White House, and Congress. Do they want to raise taxes, lower taxes? That's where you'll hear the phrase fiscal policy as opposed to monetary policy. So it says here the U.S. economy bounced back from its worst year since the Great Depression in 2020, with one of the best years of growth in nearly 40 years in 2021. Well, yeah, duh. The reason it was so good was because the previous 6 months were so bad. So I guess it depends on how you look at it. And this was a healthy combination of they say, a record stimulus, a healthy consumer, an accommodated Federal Reserve, vaccinations, and reopening of businesses that all contributed to this big year. So this really was, as I mentioned in the previous slide, March and April, this was essentially a 2-month recession, and it was essentially the shortest recession that we've ever had. Now, I'll grant that we have a $20 trillion economy, and so we've been hearing about some bumps in the road, like supply chain backlogs, materials, labor shortages, higher prices. A lot of this is all due to availability, and again, driving, scarcity drives inflation. So we can see on this chart that in the United States in 2021, the economy, our GDP, grew by 5.5%. We're expecting in 2022 for it to pull back just a bit to between 4 and 4.5. Likewise, a bit of a pullback in non-US but developed countries, emerging markets as well. And so globally, we're looking for a number of these stimulus programs to taper. Now, the hope is in the bottom part of the slide, it says that inflation is expected to calm down from 4.5% to maybe 3.7%, and unemployment dropped from 5.5, almost 5.5 to down to 4. Okay. So there's various measures of output matching or exceeding where we were on a pre-pandemic level. And it's clear that last year's recession is, if you want to call it, in the rearview mirror. Again, it's going to go down as one of the shortest in history, even shorter than the 6-month recession of the early 1980s. So as the economy moves towards mid-cycle, what does mid-cycle mean? Well, if you look at things over the long term, if you look at the economy over the long term, you can think of, almost like an ocean with waves, where we've had, 5 or 10 years of growth, and then 3 or 4 or 5 years of recession, and then growth, and then recession. So what they're saying right now is that we're entering into this mid-cycle, where we're not on the upslope and we're not on the downslope. We're kind of in the middle. And along with that, not only is that occurring here in the US, but it's also in Europe and Japan. They were hit particularly hard by the pandemic. Now, we're seeing COVID cases potentially falling globally, and those areas could be ripe for better economic growth in 2022. Meanwhile, emerging market economies may disappoint as growth in China could be constrained by regulatory crackdowns. You may have heard on the news that China is cracking down on literally everything, including they've shut off or locked down entire provinces because of an outbreak of hemorrhagic viruses like Ebola. So they're locking everything down right now, and we'll see how things pan out there. But it is kind of a frightening situation when we've got, COVID, and then we had the variant, and then we had Maricon, I forget how to pronounce it, sorry, Maricon, and now we're looking at this hemorrhagic fever virus, kind of creepy. So what does that mean to stocks? Well, 2021 was the year nearly everything was in shortage, and it translated to added inflationary pressure. So you've got both shortages, we've got shortage of labor, and then we've got the administration pumping in more and more money into the economy. It's like it's a miracle that inflation isn't like 15% right now, if you ask me. We've got record numbers of ships waiting at ports, a lack of materials, unfilled job openings, higher commodity prices, a lack of truck drivers, major backlogs, and supply chain disruptions. So we think that these pressures will steadily decrease over the next year, and inflation will eventually settle back to 2.5. Kind of more in line with traditional historical performance. And so when this happens, this more stable measure of inflation, this tended to pull broader readings of inflation towards over time. So the supply chain issue may take up to 2 years to fully address itself. So we think that overall we're facing relatively good, relatively promising forecast in the future, but we're definitely going to have some bumps along the way, without a doubt. So with regards to stocks, we're looking at prospects for above average economic growth and earnings gains. Well, what are earnings? These guys kill me. What are earnings? Earnings are essentially the profit that a company makes after it's taken into account all of its expenses and all of its taxes. So that means that prospects for above average economic growth and earnings means that companies are going to be more profitable. And this points to a very good, potentially good stock year for stock investors, While the pandemic is not completely behind us, and there are several other risks to watch, particularly inflation, stocks have done historically well in, here we go again, mid-cycle economies. not on the growth, not on the deflation or the recession, but kind of right in the middle. And we believe that we've started or are already in the middle of an economic cycle with at least a few more years left, which is good. Historically, if this holds true, then we believe the chances of another good year for stocks are quite high. The other thing that just, again, this jargon on here just kills me, but if you look at the stock market, or if you listen on the radio and you hear that the S&P 500 is up 20 points to 4,333, what in the heavens world does that mean? Well, the S&P 500 is a measure of 500 publicly traded companies, and it's considered by many to be the best overall measure of the market. So you've heard S&P 500. You probably also heard of the Dow, or the Dow Jones Industrial Averages. Well, whereas the S&P 500 tracks the performance of 500 companies, the Dow only tracks 30. You may have heard the NASDAQ composite. The NASDAQ composite includes all the stocks listed on the NASDAQ exchange, plus the Dow, plus the S&P 500. And you also may have heard the phrase PE ratio, or earnings per share. And PE ratio is just essentially price divided by earnings, and it's used as a vehicle to compare two companies' stock prices. So let's say we've got Home Depot and Lowe's, to many people, virtually the same kind of store, but one of them has, a higher earnings per share than the other. Well, then the one with the higher earnings per share would be more profitable and might therefore be a more attractive stock buy. You also hear about large, medium, or small companies. And large companies are considered to have a valuation of over $10 billion. Medium companies, 2 billion to 10 billion, and small companies from 250 to 2 billion. Well, how do they come up with the 10 billion number? Well, they essentially look at the share price. So if it's $5 a share, and there's 1 billion shares outstanding, 1 billion shares that have been issued, meaning 1 billion shares out there in the market, then that company has a valuation of $5 billion. So easy when you've heard it before, but when you read it, your eyes glaze over. So this is what we talk about when we say that 5,000 will be a nice round number for investors to celebrate. Well, that 5,000 is based on the S&P 500. I just checked it today, and it's at 4,333. So it's got a little bit of ways to go before it gets to 5,000. And the question is, will that celebration take place in 2022, or is it going to take longer into 2023? If we assume S&P 500, earnings growth improves to around its long-term average of 8%, while the price to earnings ratio stays about where it is between 20 and 21.5, 21 and 21.5, the S&P 500 could be fairly valued at 5,000 to 5,100 by the end of next year, or end of this year, excuse me. So, boy, that's a bunch of jargon. What they're essentially saying is, it's one thing for the stock market to increase in value and for stocks to go up, but there's a certain point where, golly gosh, it just can't go up anymore. So what they're saying is that there is not at the moment concern about the stocks in the stock market being overpriced at the moment. So in a mid-cycle economy, recession fears do not typically cause stocks to fall in a given year, nor do stocks typically surge as investors celebrate emerging from the prior recession. Over the past 60 years, the S&P 500 index was up an average of 11.5% during the 30 mid-cycle years we identified, with gains of 80% in those years. So again, very optimistic here. You can see stocks rose during most of those mid-cycle years, with 1966 and 1977, the only 2 years with double-digit losses. Wow. And I remember 1977, I think I had just bought my first house. And I think, if I'm not mistaken, I bought my house in 1976, and the mortgage interest rate was 10%, 10.5%. And I thought I had, robbed the bank. I thought I did great. And I had a neighbor across the street who moved in like less than 6 months later, and his mortgage rate was 16 or 17%. Holy cow. I remember that well. So the Federal Reserve, which we hear is going to start raising interest rates at least by early 2023, can help us gauge the cycle, because this central bank typically begins to raise rates when the economy is exhibiting mid-cycle characteristics. So, I think that trying to, between the fiscal and monetary policies, with regards to the stock market, what the Federal Reserve and the White House and Congress, et cetera, are all trying to do is they're all trying to steer a boat, and it's going down a canal, and they're trying to keep it from banging into the walls, banging into the docks, because it's like trying to navigate a huge ship in a small harbor. Ships don't start instantaneously. They don't stop instantaneously either. So we're expecting stocks to follow this mid-cycle pattern and potentially deliver double-digit gains in 2022 as the economy continues to expand at a solid pace. Now, with regards to bonds, it says, how much higher can Treasury yields go? When we have an expanding economy, it's a great start, but stocks fundamentally derive their value from earnings. Stable profit margins and increasing share buybacks make double-digit earnings growth for the S&P 500 a possibility this year. However, COVID-19 related supply chain issues and materials and labor shortages could lead to higher costs, potentially weighing on profit margins. And as a result, we're forecasting slightly below average S&P earnings growth. Here we go again, earnings growth of 6%. You heard that before. So, the prognosis is that things are going to be good, but they aren't necessarily going to be great, and they're not going to be bad either. So that's kind of good. Here's the big bugaboo. This is for 2022, near-term inflation expectations above the historical trends and improving growth expectations once the Delta variant recedes are reasons why we believe interest rates could move moderately higher from current levels. In 2022, we expect the 10-year Treasury yield to end the year between 1.75 and 2%. However, an aging global demographic that needs income, these are retirees, higher global debt levels. When the administration puts out these stimulus programs, they have to borrow bonds to pay for it. And an ongoing bull market in stocks, which potentially means more frequent rebalancing into fixed income, may keep interest rates from going much higher this year. Now, we don't expect interest rates to move much higher this year because starting yields for core fixed income are still low by historical standards. So what they're saying here essentially is that it, is going to take a bit of time, again, like steering the boat in the whole small harbor. We're not going to see interest rates flip from 2 to 4 to 6 like that. And yet on the top, if we look at that, we look at this graph, this shows us the percentage down of, in blue, bonds, and in orange, stocks based on the S&P 500. So you can see that when we've had, quote, bad markets, you look at, let's say 2009, 8, 9, we can see that bonds were down, guesstimate maybe 2%, when S&P 500 stocks are down over 25. So people say, again, why should I buy bonds if they yield, a small number? Well, if they yield a small number but never lose your money, they might be worth considering. So with long-term interest rates close to what we think will be cycle highs, we're going to revisit the case for fixed income within a broader asset allocation. Now, core bonds have historically provided capital preservation, diversification, and liquidity to portfolios, which we think are important portfolio construction objectives, and they help clients remain committed to their investment goals. So they're a good buffer against a downturn in the market. So with, again, the economy transitioning to mid-cycle, the need for high quality bonds increases. Moreover, the need to offset potential equity market volatility remains an important role for core fixed income. So again, we saw that bonds, particularly core bonds, have been much less volatile than stocks and have historically provide some ballast to portfolios during equity market drawdowns, which we know are normal occurrences from time to time. What's next for credit? Well, in the credit markets as the economy transitions into mid-cycle, credit investors need to be more cognizant of downside risks, because while the economy should still be conducive to credit risk and corporate balance sheets generally remaining in good shape, credit spreads are amongst the lowest they've been in years, which means that competition for the added risk of, say, corporate bonds is kind of low. So with that in mind, these are some of our top ideas and areas to avoid in 2022. So with federal, state, and local governments usually better suited for the role of timekeepers or race officials, they've had a run of a strong leg over the economy the last 2 years. No one would find this level of government involvement ideal under any circumstance, but the private economy was by no means on the sidelines while this was happening. So while some service-based industries were devastated by the pandemic, businesses on the whole innovated, adapted, and evolved. They may have positioned themselves well to take the handoff and run the next leg, and our market views reflect that. We're watchful of the risks associated with government passing the baton in 2022, but we believe that ultimately the economy will be healthier while still managing to create opportunities for investors. And the other thing I would encourage you to take a look at is I would look at this important disclosures page, because it gives some of those definitions for, what is equity risk, what is a cyclical stock, what is the earnings per share. So it might be interesting to take a look at that. So these are all disclosures, but again, they've got these definitions on them that might be interesting to review. So with that in mind, let's take a look at, real quick here, let's look at how we should consider investing in 2022. Well, I like this again, winning the race. Investment ideas that we think will run all of 2022, and that is stocks over bonds, with healthy earnings and a strong economic backdrop supporting stocks over bonds. US stocks over international stocks due to a favorable economic growth outlook. Cyclical sectors, cyclical meaning that you'll buy more of it when the market's good and buy less of it when it's bad. So it's like cars, motorcycles, boats. They're people purchasing them will buy more or less or none during downturns in the economy. So that's contrast from non-cyclical items which you're going to buy anyways, like milk and bread and toilet paper. So we've got bank loans. Economic acceleration may support demand of bank loans along with less interest rate sensitivity. So what is a bank loan? A bank loan is essentially a form of borrowing that a company would employ if they can't get conventional loans. So if their credit score is not perfect and they can't get, a loan from a big company or big bank, they would have to go to something like a bank loan. And as a result, the individual who borrows a bank loan pays a higher rate of interest than someone who gets it from a big bank. Drop the baton. These investments may not finish first this year, and we would look to keep underweight, meaning buy less of this, maybe hold what you have, but not buy more. And that is including emerging markets with ongoing regulatory risks in China, which can impact emerging market earnings. Remember earnings. Defensive sectors. These are slower growth companies that can be squeezed by higher prices and wages. Those would be like utilities. Long maturity treasuries. Again, long meaning that we were going to hold them, or that their maturity could be like up to 30 years. And with rates being so low right now, do you want to lock yourself into such a low rate for the next 30 years? Or high yield credit, because again, high yield meaning, again, not quite as bad maybe as bank loans, but similar to them. Why should you pay, a higher rate if you don't have to? So with that, I will share with you that I am going to, I've recorded this. I'm going to upload it to my YouTube channel. And you can see now that I'm on my homepage here of my website at briantsikorski.com. I think that's Lake Crabtree in the background. But if you look on here, you see Facebook, LinkedIn, Twitter, and YouTube. If you click on YouTube, I should have this all uploaded probably by Thursday at the latest. But it'll be right here. This is our mid-year outlook that I put here about last July, I think. So it'll jump right in here. So if you want to watch this again, I'll have this uploaded by Thursday. And then finally, I will also email you, you maybe already have it, I can email you the hard copy, quote, online hard copy, there's an oxymoron, that goes with this presentation. So if you want to read a hard copy as opposed to watching a PowerPoint, you can do that. So with that, I will say thank you very much for joining me. I will stop my recording here. If there's anything that I can do to help you with your financial planning, investment management, insurance needs, please let me know. Briant Sikorski, you can reach me at 919-650-1527 or briant.sikorski@lpl.com. Thanks so much and have a great rest of your